Hello everyone and welcome to this special edition of Weekends of Ventura. We have the year end of Ventura. Today we are going to discuss investing in 2020 and I am your host Vineet Bulinchkar, Head of Research at Ventura, and with me is our portfolio manager Mr. Amarnath. Hello Amarnath.
Hi Vineet. So looking back quickly at 2019, I think markets have climbed a lot of walls of worry, global as well as domestic, and done reasonably well, I would say, though it's been very polarized, which we'll get into. The interesting thing is that the slowdown, like in automobiles, is pronounced and discussed in the media. But I came across the data as a surprise that whether you look at electricity, you look at bank credit, you look at diesel consumption, and even ad spends, everything is at a 6 to 7 year low. It's a real 7-year itch that's playing up. So Vineet, what do you think? Where are we headed and what kind of more pain is left?
So you know what, I think we should go to and the history of our GDP growth and visualize. So what you'll see is pre-reform, we've never had any kind of a secular trend, always moving up and down, 1 year up, 1 year down. And it's only after the year 2000 that we have seen some kind of trend setting into the GDP growth. So we had a period from 2003 to 2008, and then subsequently after a wishy-washy move, we have seen the markets climb up from 2014 onwards right up till 2017. But after that we've had 3 disruptive years. We've had GST, we've had demonetization, and along with that we've also had this ILFS credit squeeze, which has really broken the back of the economy. So despite all these factors, what we find is that the markets have really moved up. So they have given you marginal returns, but with such kind of disruptive events, if the markets have been moving up and if the markets were to just turn around just a bit, stabilize at these levels, then we could see a very good earnings recovery. What do you say?
Yes, I think the chart that you have referred to indicates clearly that GDP does rebound very sharply after 2 or 3 slowdown years. And the only thing I think which is important now to look at is the fiscal deficit situation along with the GDP slowdown. And I think this chart clearly brings out that we have been, really, this is one success story of the Indian economy, that the fiscal deficit has been consistently kept down despite all the volatility in the GDP itself. Having said that, I think that this year is going to be a deviation where we possibly are going to miss the fiscal deficit target. And I think in the context of Vineet, what we saw about the slowdown and what you had said about the 3 successive years, the kind of major impacts of demon or GST, etc. I think a deviation of maybe 50-60 basis points from the target should be welcome and would help to sort of pump prime and help the GDP rebound sharply in 2021 or later in 2020, as you said.
So, Amarnath, I have one question to ask of you. It's always intrigues me, is that, the government has done a lot of these SOPs on the side of taxation. Okay, our spends are very high, and now the PSU divestment is also pushed to next year. So you think that this sub 4 would be possible, fiscal deficit levels?
I mean, sub 4 possibly we should try to maintain for the purpose of the credit rating of the country and to also avoid upheavals in the interest rates, which have also held well in a scenario where the deficit is clearly going to be higher than what it was budgeted. So in that context, I think holding back the expenses and managing the whole situation is going to be important.
So this is one of our favorite charts, isn't it?
Yes, that's credit to you.
Yeah, but I would like you to give your views on this.
No, I think I was surprised by this, that when so much analysis is happening in the markets about, this concentration effect, or, there are just 10 stocks which are delivering all the returns and the others are just lagging miserably. I mean, that the 10 stocks which have been the stars of the last 1 year or so, they actually were laggards in terms of the valuation multiples as recently as 2016. So 3 years has seen kind of a complete makeover of the top 10. So,
yeah, and I would also like to point out that what is happening currently now does not necessarily reflect what will happen in the future. So as we've seen these top 10 who were underperforming earlier and have been outperforming the Nifty over the last 2 years, they could possibly end their outperformance.
yeah, I think that's what it is. The market, everything has its cycles, and when we talk of sectoral cycles, I mean, I think FMCG is one thing which comes to mind, which is seen to be kind of nectar of the gods, is what they serve, despite the fact that some of what they serve may not be health foods really, but this is what many people believe. And I think this clearly highlights the fact, again, something which the market has ignored, and Vineet, you have pointed it out through your analysis, is that contrary to opinion, the FMCG stocks are actually not overvalued vis-a-vis the BSE 200.
Yeah, and one more thing is that, if you see the red line, which is the average line of the FMCG sector, our current valuations of FMCG are lower than the average of the past years. So FMCG on both counts, onto themselves as well as the BSE 200, they have kind of started underperforming.
And I think they clearly have been the biggest beneficiaries of the tax break, though the government possibly intended to give it to the capital intensive industries, but actually the FMCG are the biggest gainers.
And if we were to relate macro, with the earnings yield ratio, I think this is a very, very interesting chart, isn't it?
Yes, absolutely.
So you want to take ahead on this?
Yeah, again, I mean, if you look at it, that this is brilliantly plays it out, every cycle, that the moment your ratio of the GSEC yield or the risk-free yield to the Nifty yield goes above a certain level, the market tends to underperform. And then when it comes back to the reasonable level, which is indicated by the horizontal blue line, I mean, then the markets tend to rebound, and this has got magnified actually. This has been seen even in the late 90s, which is borne out by the chart, but somewhere from 2000 onwards, I think this is much more magnified, and clearly shows that this indicator possibly has a very strong correlation to how the Nifty behaves.
So we are in that stage where we have to be cautious with Nifty valuations.
Yes, this chart indicates clearly that.
Yeah. So even if we were to look at the Nifty PE, so currently we are even much higherly or more richly valued than even when we were in the frenzy over the bull market in 2000, 2008. And that also ties in with our previous chart.
Absolutely. This is the simpler version of the previous chart, which correlated, the GSEC yield with the Nifty yield. This is much more straightforward. And if one looks at it, the only good thing is that the ROEs have reasonably held up in the Nifty in the past few years, and hopefully should inch up further going forward.
So Amarnath, is it time to visit the midcaps again?
Yes, looks so, but I think one has to do it with a couple of clear caveats in mind, because history says that midcaps, have maybe a 12-month or a 15-month good run, and then after that they tend to slow down substantially, giving up most of the gains they made for investors. So I think that is a caveat. But with our systems, banking system, Demon, GST, etc., having cleansed up things a lot, my sense would be that good mid-caps could have a secular run like the large caps have provided time and again. So that's the thing one needs to watch out for and pick those kind of stocks. But as you said, clearly your chart indicates that the valuations seem to be indicating that the convergence has come to a level where mid-cap outperformance should start manifesting or showing up.
So clearly the red line is your BSE mid-cap line, and the blue line is your BSE large cap stocks, and you will notice that every time these kind of converge, the fund flow starts happening into the mid caps, and they kind of tend to pick up, and we have seen that kind of initial reactions happening in the market, in the action during the past couple of weeks. So Amarnath, where are we headed now?
Yeah, so I think it's time to get the right themes, because I think the last few years has shown us that possibly themes have become more important than just valuations. So I think understanding the themes, etc., is important, and I would tend to agree that proper distribution or weightage across these 6 themes that you have identified is possibly going to help you significantly outperform, for any portfolio to significantly outperform the benchmark indices it measures again. So I think these plays, and we could talk about some of them in greater detail, I guess. So over to you.
So as Mr. Amarnath, he's a master stock allocator, as apportioned it. So we have got, he's very very positive on dividend buyback stories, and we are looking at restructuring stories. So in the dividend, we like Nalco, Coal India, Hindustan Zinc, and mind you, Hindustan Zinc could be a good play given the asset reflation story.
Yes, and Nalco, and all 3 actually incidentally are in a sense commodity plays.
Right. And tell us more about your restructuration play.
Yeah, restructuration is essentially that companies which were seen to be getting stretched in because of policy issues, because of regulation, or because purely just because of debt, or because of valuation discount getting played out. And so Reliance, clearly we have been hearing off and on about how the restructuration in Reliance is going to play out, and it looks like 2020 has to be the year when it should actually happen and be delivered on the ground. A telecom story is looking good for those who can win. The winners will take all kind of situation is emerging, and Bharti could be the sort of undervalued play there. Adani Group, again, some might say it's a stretch. The group has overstretched itself, but again they are also seemingly getting it right by raising equity and restructuring themselves, selling some assets, diluting their stake, promoter stakes, etc. And Bajaj Holding is basically a story of whether the promoters decide to reward shareholders and do away with the holding company discount which has plagued investors, and maybe they could be the first group in India to actually reward shareholders and do away with a holding company concept altogether.
So we have also got this third theme, which is the commodity China link play. Do you think that you allocated less to this sector?
Maybe it would be slightly on the lower side, partly because of the fact that if you look at the US-China trade treaty, even the so-called phase 1 is still quite vague. It's not very explicit. Yeah. So one could possibly see ups and downs coming there, and it may not be a secular trend. So that's the reason one has brought it on the agenda, but kept it on the lower side.
But that's a good place where if the India transfer of production business from China to India plays off over a period of time, or we get more clarity on the government policies regarding Make in India, I think you could up that.
Yes, but one would rather prefer to see traction in it rather than be overweight on an assumption.
Right. So tell us more about your proxy plays for the Indian economy.
Okay, proxy plays are very straightforward. I mean, L&T is possibly the best run and best managed, best balance sheet in the infra and engineering and capital goods story. Reasonable valuations. So that's there. ACC, again, one of the best run multinational cement company, and in terms of EV per ton, etc., possibly the valuations are just above a replacement cost. So again, very attractive in terms of valuations. ESAB India, again an MNC, and clearly the whole story of consolidation in the welding and the accessories, consumables of the engineering industry. Again, a China factor there also, because a lot of the polluting competitors in China are shutting down. Torrent Power, again, this is more of reforms, because clearly now I think banking reforms have happened,
So now I
Electricity
think-
reforms are inevitable now. We have had 2 rounds of failed restructuring of the sector state run. So I think state run cannot continue. So they are well positioned to play that. Siemens, again, we recently heard about the railways being restructured and reorganized for the first time, and private trains and reduction in freight to get back and reduce the subsidy through on the passenger side. Music to the ears, and we hope this time it happens.
Yes, we're keeping our fingers crossed.
Yeah, and ITC, I mean, it's been a laggard, but I think uska time aayega.
Uska time aayega. Well, and we also have your dark horses, Amarnath. So, Aurobindo Pharma, you know, the 5-year negative returns. You
Yeah.
think that they can really turn around this time?
Yeah, Aurobindo Pharma is a sort of always the bridesmaid and never the bride kind of situation. But having gone through that period of fire over the last few years, and almost all pharma companies in India have gone through that. So maybe this one looks to offer the highest upside in terms of taking that risk. So maybe a small allocation to that makes sense. Camlin Fine Science is a really a small cap idea, and possibly it did acquisitions beyond its capacity to digest. It's taken them 3 years of real pain, and looks like things are stabilizing and turning around there. And DLF is clearly a company which is in real estate, well organized. They have deleveraged themselves substantially after the sort of deal they did on their commercial assets, leased assets. So, and recently we heard about how the project they completed and then brought to the market got lapped up very quickly. So I think they have already learnt the marketing act together. So these would be 3 we would like to bet on.
So we are looking at all the trends play out again. HDFC Limited, ICICI Bank, Nestle, Marico, IRCTC. So all the theme out here, Amarnath, is completely monopoly plays, right? Having the bigger...
Yeah, multi-year, these are going to be multi-year trends. I mean, and both HDFC Limited and ICICI Bank clearly have subsidiaries which cater to the whole gamut of financial services, not just the pure banking and lending side, but you have insurance, you have investment banking, everything is there, life insurance, general insurance. So it's all well packaged, and each of their new babies is becoming a leader in their own field. So which is a good thing, and these are the sectors which have the multi-year growth ahead of them. Similarly, on the food side, that's again, I think the kitchen of India is changing, and I think Nestle and Marico seem best poised to capitalize on that. And IRCTC is a play on the e-commerce trend, and because there is nothing else listed as of now, they are there by default.
Yeah.
If anything comes up, maybe it will help them get revalued, because valuations, as we know, in the e-commerce space are very rich. So,
and finally, your 7-year H has given you 7 themes, and your 7th theme is about being opportunistic, and only one play out there.
Yeah, I mean, it's about being in cash, because one can sense that there could be some more corrections in terms of the market, as we have seen based on various other analysis that you had presented earlier. And the one option to cash could be to put it in InfoEdge, which hopefully in the next 15 months should start unlocking a lot of value in its investments.
So Amarnath, please explain this slide to us.
No, I think this is your creation, and I think it captures everything in one screen, which tells you about everything compared on ROE to book value kind of situation. Price to book, ROE versus price to book, and clearly, as we can see, most of the picks we have are on the moderate to lower side on the ROE, and that's the rebound in ROE we are expecting, and therefore we are expecting an expansion in the price to book value. So that's, I think, the broad theme running across all the stock picks within all the 6 themes.
Right.
Just to wrap it up, I think domestic issues going to be more important than global issues, clearly for India for 2020. GDP wise, we might still see some more pain and you will see bad headlines, but that's the time you should look to behave like a squirrel and accumulate some of the names we have recommended maybe. And fiscal deficit too, time to deviate from the glide path. Two contrarian things which we are highlighted to you is crowding into quality is not as skewed as perceived, and a correction will possibly happen in the first 2-3 months of 2020, not later, and that correction should again be a buying opportunity. So that's it for now.
So folks, that's all from us, and happy investing in 2020. And if you have any queries, do comment in the comment section of our YouTube page.